Good afternoon and welcome everyone to the homecoming edition of Constellation's series of energy market intelligence webinars, coming to you live from the broadcast center at Constellation headquarters in Baltimore. We hope to bring you another informative discussion on what's driving prices in oil, natural gas, and power markets right now. So my name is Greg Kozier, and I lead the commodities management group within Constellation. And as always, I'm joined this afternoon by some of the top minds in the fields of meteorology, economics, natural gas, and power. So by way of introduction, the wizard of weather is with us today, Constellation's chief meteorologist, Dave Ryan. He's just come down from the weather lab to give us his read of the tea leaves. And on the latest date, he's pulled down from the Constellation satellite network. Fed Chair Jerome Powell's close confidant and dear friend, and our chief economist, Ed Fortunato, is here. He's going to help us understand the Fed's latest move that should be hitting the wire any second and how it will affect energy prices in the all things economic segment. And then two of CMG team's resident experts are in residence today. Keith Pauley is here to cover production, storage, and power market risks. And Brian Habasivich will bring us up to speed on LNG, his thoughts on buyer positioning, and the latest report from the Habasivich Organic Tomato Farm. Over in the panel on the right side of your screen, there is a PDF copy of the deck if you'd like to make the deck your own today. And I'll say that again, since we get this request every month to share the slides, you can download a copy of the deck right now using the link in the panel on the right side of your screen. It's free right now, but we charge after the broadcast. There's also a chat box in that panel to enter a question anytime during the presentation. Please feel free to do so and make this an interactive hour. We've also provided a link to our glossary page in that chat box as a reference if you hear terms with which you are unfamiliar. And then finally, as always, we are recording this webinar and we will send you all a link by the end of the week. So a couple quick thoughts before we start the discussion. When we started the workshop, the topics for this show last week were mainly focused on weather and production, and how they would likely be the two factors that are going to cause storage to swing either high or low by the end of the injection season. Then news of last Wednesday's incident at the Freeport LNG terminal hit the wire. And nat gas and power markets have been sort of stumbling ever since. Freeport released another announcement yesterday regarding that repair work that they need to do, and prices on the NYMEX immediately went into free fall to the tune of about 17% for the next few months, and then really off significantly through the end of the winter strips. So combine this with the uncertainty around the ongoing situation in Europe, constant news about the economy like inflation running hot, real earnings that can't keep pace with inflation, forecasts for a recession. One prominent financial voice has even termed this a hurricane heading our way. So the questions that have been posed to me a few times since have been more or less, is this it? Is it all heading down from here? Now we've seen the NYMEX today. NYMEX, perhaps this is a dead cat bounce, but we want to address these questions. We'll cover what got us to where we are now and some of the fundamentals that can move this market up and down in the coming weeks. We'll try to explain why the gas and power markets are having a difficult time finding what could be considered fair value. While the news around the Freeport terminal probably moved prices closer to fair value, cautious is the right word I think to have in mind at the moment. So yes, we are seeing a slow growth in production and storage deficits. That may fall as gas is trapped on our shore for at least the next few months, and those are bearish for prices. But we also know we have the Fed taking an aggressive stance to fight inflation. The announcement, again, we're going to find out exactly what they're doing. I think
2:30 today.
2:30, yeah. So we'll find out mid-broadcast. And we're facing what could be record heat for summer and therefore power demand. So here's a quick look at how we're going to spend the next hour. So Dave's in the leadoff spot to tell us what it's looking like for perhaps a top 3 June in terms of heat and how good of an indicator that'll be for how summer will shake out overall. He'll also give us a read on the tropical storm outlook and if that's going to squash demand or squash production based on those paths of those storms. Ed will walk us through his economic dashboard, tell us which lights he sees flashing red, and whether the Fed has their policy decisions on the right path to bring the economy in for a smooth landing. He'll also explain why your summer road trips are going to cost a lot more this year. Brian will walk through the news out of Freeport in more detail, explain why this displaced events and perhaps the top driver for prices in Eastern Europe, at least for this week, and whether this improves the tomato crop outlook. And then Keith will review production, storage, and identify the ISO's most at risk for reliability issues this summer. So the team will then revisit purchasing strategy. We've done this in recent months. We hope that gives you better information, perhaps some better ideas for how to manage your energy position, protect your business from volatility, and ultimately finding a signal through the noise. And overall, we hope this review helps you understand what's happening in the markets right now so you can ultimately make better energy decisions for your business. So thanks again for joining us this afternoon, and I will hand it off to Dave to start us off with the weather.
All right, thanks, Greg. And
We are seeing some heat across the southern United States. If you're hot now, chances are very high you're going to have a hot summer coming up here. So far, there's over 100 population-weighted CDDs in the book so far, and that was through the 13th of June, so we've realized a few more than that. Our original forecast called for about 270 population-weighted CDDs. We're probably looking at closer to 290. 290 would be the hottest June on record. So you can see much of this heat coming out of the southern United States, some of it over into the mid-Atlantic area. Texas had its hottest May on record and is likely to have its hottest June on record as well. Looking at both the European and the American weekly forecast show a continuation of this pattern through the rest of June. Some mixed variable weather across the north and northeast, where it's been struggling a little bit to get hot so far, but I do think it'll come around as the summer goes on. We've had plenty of heat in the south, and that's expected to continue through the end of the month at this point. Also, some heat in California has been realized. We've seen temperatures soar over 100 degrees in Sacramento and Burbank already a couple of times this year, and it'll be cooling off as we head through the weekend. I think both of these weekly models are a little bit too cool in California. The coolest place, I think, in North America relative to normal is probably going to be the Pacific Northwest, and I don't see much in the way of demand coming out of there. However, the heat across the south up through the mid-con is enough to propel June at least into the top three, and it's becoming more likely now that we are going to see the hottest June on record. Looking at the rest of the summer, all of the forecasts that I've seen out in the marketplace, whether public or private, have leaned toward the hotter side. There have been some that have been a little less than others, but generally speaking, with the June that we have so far, and then looking ahead to July and August, I think right now, if I were to say that if July and August continue to see some of the same pattern that we're seeing right now, we're going to be in the top 5 hottest summers of all time. And it could be the hottest summer on record, depending on how things go. It's really going to come down, I think, to the tropics as we move into August, which I'll explain in a minute. But we're continuing to see heat spikes across the Midwest, and some of that may eventually get into the Northeast. But right now, so far, it's been struggling there. And I'm thinking at least the top 3 hottest summer for ERCOT, given what we see in the forecast. The Southeast, we may start to see a little bit of tropical activity down and through there. It's been hot. It should continue to stay hot for a while. We've got a severe drought going on in the western states, and that's going to, I think, propel California heat continuing, especially as we get into July and August back there. We're going to see more 100-degree temperatures in the interior. The coastal areas may stay more mild, but I think the interior areas with the drought are going to be quite hot. Monsoon season in the Southwest will probably curtail some of the desert load, but overall, I still think it averages above normal there. As I mentioned, the Pacific Northwest is probably in for a variable pattern that probably stays milder. Looking at Dallas and Texas in specific so far, you look at the number of 90-degree temperatures and the number of 100-degree temperatures so far. They both rank third in their records, which goes back to about 1900 for the National Weather Service. We like to use 1950, but overall, it's looking and shaping up to be a very hot summer for ERCOT. They've already set record loads in terms of power down there, and I suspect more of that situation is going to be coming up. One thing I will mention is that wind generation so far in ERCOT has been fairly high, and that usually is the case when you get May and June heat. But as you go and progress through the summertime, that may not be necessarily the case, particularly as you get into August, as the ridge can settle over that area a little bit more, and the winds can be a lot lighter during that time frame. So we've had good wind generation so far, but I'm not guaranteeing that the wind's going to be as strong in ERCOT going forward, especially as we move into the latter part of the summer. So on the next slide then, this is about the tropics, and we continue to believe it is going to be an active season. Most of the public and private forecasts that I've seen are for 20 named storms or around there, with above normal tropical storms, hurricanes, and major hurricanes all forecast. National Weather Service, NOAA's in that boat as well. They're forecasting anywhere from 14 to 21 named storms, major hurricanes upwards of 6. You see the list down there. We've already had Alex. Back in the bottom right is the water temperatures, the cooler water temperatures, which I've outlined, of the La Nina going on, and that usually provides generally good or favorable conditions for tropical activity in the Atlantic Basin. You combine that with the warm sea surface temperatures that we're seeing out in the Atlantic in the main development areas and also in the Gulf of Mexico, spells trouble for our coastlines. I still believe that the Southeast is probably the number one risk area, and I think it's almost close to 100% that we're going to see at least another tropical system, if not hurricane, make landfall there. You go up into the Northeast, I think the risk is probably double normal up through there. So the East Coast is still under the gun. One thing about the Texas area, if the ridge does settle in there or stay in there, it may suppress tropical activity to their south. So it's something to watch for later in the summer. Right now, it looks like maybe the best risk, or the greatest risk, I should say, is more to the east of Texas toward Florida, the eastern Gulf of Mexico.
All right, David, thank you very much. I think the news, actually, we got to jump to the breaking news, basically. The Fed announcement came out, 3/4 of a basis point, 75 basis points, I should say, 3/4 of a full point. Ed, your thoughts on that, your immediate reaction, and then we'll move over to your dashboard.
Yeah, just it wasn't a surprise that they raised it. You know, they've announced that they're trying to be aggressive in this. My thoughts are, this is a supply-driven inflation. You know, lack of production from gas and in oil, and we've talked about that before. You know, why the case is that, you know, there's grain shortages. You know, the Fed controls demand, and they increase demand when they lower rates, and they decrease demand when they raise rates. And no matter what the Fed does, you're not going to put baby milk on the shelves. You're not going to make people less hungry. So at the end of the day, they're going into a gunfight with a knife, and it's just not really going to work for them. And you can do great damage to the economy, but you're not going to solve the underlying problem. The Congress can inspire supply. They can give tax credits. They can do all sorts of stuff. But at the end of the day, you know, it doesn't seem like anyone's really interested in doing that right now. So we kind of have a standoff right here. And unfortunately, you know, what's going to happen is the consumer's going to suffer, and the people who are big beneficiaries of all the largesse of the federal government the last couple of years are going to kind of be hammered right here. And you're starting to see that already.
All right. So give us some of the indicators that are blinking red, and these are clearly the ones you discussed with Jerome Powell earlier this week.
Yeah, me and Jerry, we got together and we had a little breakfast. And, you know, some of these are supply issues, and some of them are just kind of what we're doing to ourselves. Car and truck sales are a supply issue. They're computer chip sales, you know, shortages. And at the end of the day, with computer chip shortages, you can't make as many cars. And in April, the figures that came out were like 14.9 million cars, which is the best one we've seen in quite a while. We still average between 17 and 18 million car sales a year, and we're down to just about under 15. Well, in May, we were 13.1 again. So it was just kind of a surge of production. So until that gets solved, you probably don't see an easing in inflation of used cars or new cars. You know, you can go, you know, equity markets, the VIX. You know, we've taken $12 trillion of value out of this economy since the start of the year. And that's the amount of value you took out of the economy when you had the COVID shutdown. And, you know, the Fed stepped in aggressively to stop that problem. And now the Fed's stepping in aggressively to continue the problem. So that's just not going to stop. And then, you know, I'll throw in cryptos for a second here. You know, the cryptos are worth almost about $3 trillion in total market cap. We're under $1 trillion now, we're like 800 billion. You basically have taken, you know, just in Bitcoin alone, you've taken an Apple store, removed Microsoft from it, and you're left with Chevron Texaco as far as value goes. So you've destroyed another, you know, $2 trillion in value. You know, it's just, you're taking all this money out of the system that you pumped in before and have done even more. And you're doing it on a sudden basis. Now you're taking consumer confidence out, which is another indicator of problems. You know, federal spending has gone, you know, back down to historic levels, which is a big shock to the system in action. You know, home sales are suffering because inflation is high. Fed's raising interest rates and people are losing interest because of the monthly cost of things. So the whole combination of things, you know, you mentioned the economic hurricane on its way. Well, for most people right now, it's people are soaking wet. You're losing roof shingles off your house, and your basement's flooded. So it may not be a hurricane by name like Superstorm Sandy, but it certainly feels like a hurricane.
That was a Jamie Dimon reference, by the way.
Yes, it was. Yeah. Who I have immense respect for. He's a guy from Queens. I love the guy.
Yeah, and he's done well.
Yeah.
So go ahead. So moving on, then give us some of the indicators of the warning lights that you're not seeing blink yet.
You know, most of the things that aren't blinking are lagging indicators. Most of the stuff we just mentioned are leading indicators or real-time indicators, things that are showing problems right away. You know, unemployment, it takes a while to cut jobs because things have to get bad before they do them. There's also a situation in this country where we have 2 jobs available for every unemployed person. So at the end of the day, you know, it's going to take a while to shake that out. You know, orders are still lagging because there's supply issues. You know, wage growth has been really strong because we still have, you know, overemployment in this country. So there are a whole bunch of different things that haven't been addressed in these things yet, but it's on its way.
What's the sham rule? You referenced that as an indicator not yet blinking.
The ShamWow rule?
It's the sham wow guy.
The ShamWow guy, yeah. But Vince Shalomi, I never thought we'd discuss him on this show. But the sham rule is a rule that talks about recession indicators. The Fed loves to use it and look at it, and it's showing almost zero chance of recession right now. And it's because unemployment, short-term unemployment has to cross over long-term unemployment, and you haven't seen much of a change in that. You know, Brian made a great point the other day about, you know, weekly unemployment increased by 20,000 people, but you're still at the lowest level since like 1969. And in 1969, you had half the amount of people in this country that you have now. So the employment is very, very strong, and that's going to need to change before we, you know, really see everything go. And to just add one more point, you know, when you talk about recession, it's almost like electing the Pope. There's like white smoke coming out of the chimney. You know, the National Bureau of Economic Research, which isn't government regulated or a government entity, comes out and says, okay, this is officially a recession or officially not a recession anymore. It's very ceremonial, and it has to do with a couple quarters of GDP and other factors coming together. But at the end of the day, when you see this combination of things, it's really in a recessionary environment, whether it's officially been declared or not.
So would this be some of those ideas, some of those comments, and some of those thoughts as to recessionary things?
Sure.
Yeah. And so if we look at this graphic, clearly the things that stand out as having had the greatest change is fuel oil and gasoline.
Yeah, sure have.
Which is actually a nice segue. So these are some of the indicators that are blinking. If we then transition here to just another slide, we'll talk a little bit about what we're seeing happen with OPEC and gasoline prices.
Yeah, and one of the things you talk about supply, people feel comfortable in their cars, and they're driving around whether they commute to work or not. And if you look at percentages of people commuting to work, you know, white collars have gone from 5% working from home or working remotely to about 45%. And you know, the gasoline demand in this country is still the same. So people are driving somewhere, they're just not driving to work. And one of the questions I have a recession is, generally recessions kind of follow a track. You know, interest rates go up, you know, things get more expensive. You fire a bunch of people who make cars because they're too expensive because the interest rates are too high. You fire a bunch of home builders. They stay home, gasoline demand goes down, and all of a sudden prices get low enough and the Fed lowers rates because they get concerned, and the whole cycle starts again. What are people going to do now when you're looking at unemployment? Are people who are working remotely going to have to go to a job? Now you're going to increase gasoline demand? Are they going to stay home and just not drive anymore because things are getting tight? There's a whole bunch of different variables that you're looking at in this recession than you've seen in previous recessions, which kind of makes you scratch your head a little bit.
Well, this is Brian. I would also question how much OPEC Plus can do about boosting supply in the base case. I mean, we've heard how much spare capacity is there?
2 million barrels?
2 million, yeah, 2 million. Well, that could help, but even if there's 2 million barrels a day of spare capacity with an OPEC Plus, that doesn't mean it can just be turned on by turning the spigot. So maybe 1 million of that could be turned on.
Sure.
But again, we're not in a good position with respect to spare capacity globally. And it speaks to what the OPEC minister said last week, which is the entire global industry is chronically undercapitalized. We've talked about this before, that global CapEx in oil and gas peaked in 2015 at $600 billion per annum.
Right. And then prices
now we're down
low.
to 3, and we're down to 300. So it's collapsed to a very, very low level, and it's been chronically underinvested for a long time. And that speaks to the future, the forward curve on this stuff, because we need to rebuild the chronic undercapitalization of this market for not just the domestic natural gas and oil business, but also globally. And until that happens, the short fixes are not going to be in.
So let me just give you a couple of numbers to illustrate Brian's point. You talk about 2 million barrels coming offline or having to add to the market. Think about Russia.
Right.
Russia makes 10 million barrels a day. Sorry, Keith.
No.
They export about 7 million. That's going to go away, or most of it's going to go away. They're going to lose their ability to produce because their ability to produce is mostly based on, overseas companies or Western companies helping them out. Then you're looking at just the United States alone. Pre-COVID, we were making 13 million barrels a day. We haven't even reached 12 million barrels a day. And now we're going to Venezuela and Iran for extra oil. It's like you scratch your head and you say, what are you doing? We have a resource here, and we're just not applying it. And, on either side of the aisle, and I'm not going to get this political discussion, there seems to be no desire to increase this. And, ESG has stepped in and said, hey, we're not going to finance much of this. There's a whole bunch of different things that's not going to dig us out of this right now. And it's very concerning.
Yeah, and then you have to look at the refined side. So we're talking a little bit about just the raw material, the crude.
Sure.
Right. But even if you pull the crude out of the ground, and we recognize there's going to be challenges getting that out of Russia, you still have to refine that into something that's usable for everybody listening to this phone call.
Yeah.
Unless they've got a teapot refinery in their backyard. But if they do not, you're then competing against the effort to green the economy, correct?
Yeah.
You decarbonize. So there isn't exactly a lot of incentive out there for refineries now to go out and build another site.
We haven't built one in this country since 1977.
And in fact, we've lost several in just the last 5 years.
They're immensely complicated facilities, and when they get old, they're really expensive to fix.
That's his key. There's one in the Houston Chip Channel that was built in 1918 that they're going to retire by this year or next year. I mean,
Right.
And it's 200,000 barrels a day. So
Yeah. And we've lost about 3 million barrels of capacity since COVID started.
Right.
So you're looking at this going, and we still have enough refinery capacity in our country for right now. But it used to be a surplus and we'd export it. Now it's getting more and more difficult. And I'll make one more point before we got to move on. But the inflation we saw in the 70s came from a lack of supply of oil, and we were much more energy intensive those days. And at the end of the day, right now, the thing that solved inflation, and I give Paul Volcker all the credit in the world, was Alaska North Slope oil, North Sea oil, West African crude. And we don't have any of those on the horizon right now. And until we either dramatically change our energy profile, we're not going to solve this problem. This isn't an overnight solution anymore. And, and on top of it, we're still, based on natural gas prices, versus crude versus coal versus international gas, we're still the cheapest BTU on the planet. They're going to be industrial processes coming our way.
Yeah,
So-
Europe can't operate. The factories can't operate on the current price of gas.
Right.
Without Russian gas.
So they're going to be increasing demand here while prices are going up. And until we solve that global arbitrage between those, the overseas gas and overseas oil, we're going to have trouble here.
Okay, so we've transitioned a little bit to talking about OPEC and gasoline to natural gas. And so we'll hand this off to Brian. I'll say that, Brian, it was a week ago that we were sort of getting comfortable with the new high in natural gas. Prompt prices on the screen were $9. Everybody was getting comfortable with the heat. The global market for natural gas was running hot. And then all of a sudden, some news came out of Freeport, Houston Ship Channel area, and things turned a little bit. So that's when the screen dropped a full $1. All of a sudden, tanker deliveries are going to be slowing down. Most of the tankers had been going to Europe. Take it from there.
Well, I'll start with Freeport flub forces fuel fallback.
I think Dave Ryan came.
Did who? This,
I was wondering if you're going
this
to
is
say
a massive tongue twister. I challenge anyone to say that 20 times fast, let alone 5 times fast. So
It's very alliterative.
it is very alliterative. So you're exactly right. The potential, we talked about headline risk a lot in the last couple of webinars, and one of the reasons why we were playing defense in the front end of the market was because the upside potential for headline risk we felt outweighed the downside price opportunity for headline risk. However, we got a headline that drove prices down, and there's a number of different takeaways from what happened at Freeport relative to commodities markets and to the direction of pricing action pursuant to relatively small, what appear to be small demand or supply fluctuations in actual volumes. So let me put that in perspective. We're producing 95-ish BCF, billion cubic feet per day of natural gas. We're talking about a supply pickup here in this case of 2 BCF a day. So about a 2.5% impact on the supply side to the good in this case. We're picking that up because it's an export terminal and that gas would normally be going out of the country. Now it can't go out of the country. So now it's available for domestic consumption. And so we picked up, it's just like if we announce tomorrow or announce in a day's time that producers picked up another or produced another 2 BCF a day miraculously overnight is now in the system. So we increased the supply availability by 2.5%, and the price fluctuation is 17%. It's multiples of that. And I think a lot of people need to understand that that's how commodities markets work. They're not linear. They don't, if you get a 2% increase in supply, you're not going to get a 2% decline in price. You're going to get a large impact. Similarly, if you lost those 2 BCF on the supply side, you would have a massive price response the other way.
And just we saw that in Europe. Prices went up 20%. TTF rose about 20% on the news.
Right.
They're not getting the supply.
Yeah, so all the benefit that happened here
was paying there.
Was paying there, and it's almost. Do we know if Vladimir was behind this? I mean, this is such a bad event for Europe.
No,
Russia must be behind this.
No, I don't think so.
No, not at all.
But Gazprom is cutting Nord Stream 1 40% with compressor problems.
Yeah, compressor problems.
So
You know when you have high margins like we've seen, maintenance on these facilities is intense and consistent, and you delay maintenance and things like this happens.
And these are relatively new at this point. I mean,
Yeah,
you can begin to think that if you start to play this out, and as these facilities naturally just age, the maintenance requirements are going to go up. And clearly, this is going to be something that gets heavily scrutinized. The pipeline hazardous materials group will be investigating.
And take a step back to refineries. They're very old in contrast to LNG facilities, and things break, and the margins are high, so they're delaying maintenance, and all of a sudden, bad things happen.
Right.
Yeah, I think so a couple of the other takeaways are that when we caucused on Thursday, the day last week after the event itself, the company had said it was going to take 3 weeks to get it back up and running, and I think we're all pretty skeptical of that.
Absolutely.
Coming in, going, maybe
it takes a while to do a root cause analysis.
It does, and so with that, we saw the price drop $1 initially in the overnight trading, and then the news came out. It's only a 3-week episode, and the prices went right back up to close to $9, as you saw. And I think again, a takeaway is a couple of BCF a day can drive the market down $1. And the minute that it was apparent that it was only going to be 3 weeks long, at the time that the report was, it's only going to be 3 weeks, the market went right back up to equilibrium at 9. And then they came out and said, okay, it's going to be a lot longer. We're going to maybe, end of year, a couple hundred BCF is going to be sprung into the market. And that's when the market really tanked. But since then, you're seeing it solidify around 750-ish, more or less, to look for some more direction.
And it's about 220 BCF, 90 days for the 90 days will bring partial return, so assume 50%. Right. It's 180 BCF, and then another 60 days, so 220 probably on supply impact.
And you start doing math on that.
Just before you move on to the graph that everybody's looking at right now, which is where these cargoes go, what the market will be very focused on at this point is that return date feasible? Yes. Meaning, is that conservative? Do they potentially come back earlier?
Right.
They'll be looking for any indications that the facility is restarting, that perhaps the tanker is starting to come into port. Any indication that gas is going to be shipped out is going to be very bearish. If that precedes the date, which right now is somewhere around September where they potentially transition, or conversely, any indication that is running longer, then that's very bullish for prices.
Again, there's a headline risk out here. That's the point. That the headline risk is real. It can move markets a lot, and I still am in favor of what we talked about earlier in the summer, coming into the summer. Playing defense in that market makes a lot of sense because the downside opportunity is still not as good as the upside price risk. In other words, the upside price risk is much greater. than downside price opportunity. So in that case, you have to manage the upside price risk.
So Alex, I'd say back up a couple steps just so we can see that chart a little bit larger. And Brian will tell us what we're looking at there just in terms of where these cargoes go and again, the impact on Europe.
So this is where this looks like an old Star Trek bridge shot. If anyone of you familiar with Star Trek from the 1960s, but
I thought it came out in the
80s. No. I think the point here is about 60% of the deliveries from US LNG are going to Europe. And obviously there's a war going on in Europe. We have a massive potential for energy supply disruption and cutoff and actual real shortages of natural gas and other forms of energy in that marketplace. So when the Freeport announcement was made, and the news was delivered on Wednesday at 11:40 in the afternoon on last week, prices in Europe automatically started to move up. And then after it was discovered, or after it was decided that the outage was going to be much more long lasting than 3 weeks, prices really started rocking in Europe, because now the gas is backing up in the US because it's an export terminal again. So we have 2 BCF a day of new supply here that we found, prices go down, but in Europe, they just lost 2 BCF a day. So prices are going up.
And Brian, just to, that impacts the Northeast because we import LNG into Boston, and therefore that's going to influence Algonquin Citygate has to trade certain parity to TTF, and Transco Zone 6, New York and non-New York can spill over to that if, you see continue run up in Northeast power and gas prices for this coming winter. So
exactly.
Not immune from spillover there.
Correct. So that has carryover.
And it's one of the rare times that you see a piece of storage or gas information that affects the market where you can kind of extrapolate some math from it. And, you get gas storage once in a while, and that's either hit or miss, or, you don't have much of an impact because they figured it out a little bit. But this is one of those rare times you can do that. And even with the big drop we've seen, option premiums are still favoring the upside dramatically.
Yeah. Production's still where it is. That hasn't changed.
All right, let's move on a slide here. Alex, thanks much. And there we go. Let's talk a little bit about production.
So I think production is sort of the ace card in the deck, if you will. We'll talk a little bit about poker in a minute, but sort of the ace card in the deck. And I think we've said this a number of times, so I'm repeating myself, but through the noise, the market's looking for the signal. And if there's one signal to me that the market wants to see, it's production getting up what I'll call above the dotted line. And you can see the dotted line in the upper left-hand corner of the screen here on this diagram. And that's what I'm referring to when I say the dotted line, the green dotted line. And production has been below the dotted line. That's the EIA STEO. We call it the STEO, or the short-term energy outlook, the STEO. According to EIA, that's the Energy Information Administration, that's the Department of Energy. Their forecast is calling for 99.5 more or less BCF, billion cubic feet per day, of output production by the end of the year. So in order to get there, that you're following this trajectory of this path, this dotted line. And we've been below the dotted line. Now we have made some adjustments that got a little bit more actual production than we had in the previous numbers.
We're up about a half a BCF last month.
But the point here is that we're below the dotted line, and we need to get on that dotted line. And we need to get probably above the dotted line to give confirmation and comfort to the market that we're going to be able to loosen up on the supply demand. And then, even then, it's a challenge. Even with the 2 BCF that we picked up, because that doesn't show up in this line. We actually picked up 2 BCF a day. So we could really theoretically say we're at 97 now, couldn't we, Ed?
You can, but it's short term, it's temporary.
Understood. But as long as that's backed up here, you
can call it that, sure.
You got it.
And you know what?
But a hot summer could burn through a lot.
Well, that's my next thing, because I'm sitting right next to Dave Ryan, the king of, using poker analogies here, the king of weather. Can we say it, Dave?
Poker or not is the king. Poker or not is the king.
That does play later. That does play into a future.
Dave is the weather king. I've declared it right here. But yeah, with the maybe hottest summer of all time, we could have that could easily eat up that 2 BCF a day, easily. So we're not anywhere near out of the woods. The 2 BCF a day is a check on the market to the upside to some extent. Again, getting back to, you might get some good news from Freeport from their perspective. Hey, we're going to get this thing back online middle August. That could, think about what that might do to the market in the teeth of the hottest summer ever. So I'm very cautious about the good fortune. It's not really good fortune, I guess. A strategy. I published an internal memo to our sales force after the event at Freeport, and I said, waiting on an LNG fire is not a very good strategy for getting a relief in pricing action.
And it's good news only if you were short and getting crushed from $2.
Yes. So we need to get above the dotted line. That's the biggest signal that this market is really looking for when are producers really going to get up and respond to these much higher prices. And I think they will. I mean, I think that there's a reasonable, there's too much money on the table right now. There's too much temptation. I don't think they're going to go hog crazy and irrational like they did in the past. But I think in a lot of boardrooms right now, there's a lot of people sitting around saying, how can we deploy capital? I know there's a lot of challenges on the supply side front to get steel and pipe and labor, but despite all those things, the industry has a way of performing. And I think
innovating its way through a lot of times.
I think there's going to be a lot of pressure to get, hey, let's get some more production at these numbers.
And a lot of that's going to come in the Permian Basin, West Texas.
Yes.
You've got that's where most of the gas rigs over the past year have been added, and oil rigs as well. You do have additional compressors that are going to be added at 2 existing pipelines, Permian Highway and Gulf Coast Express. You did get approval. MLPX is proceeding with the Matterhorn pipeline. It'll run from Waha to Katy. It'll open up in 2 years, but this year you can add a little bit this year. It's from one area they can do it because we look at the Northeast, there's limited takeaway capacity. We've got 24 BCF of takeaway capacity out of the Northeast. You can see a lot of it was built 2015 to 2019 there. Nexus and Rover and some other pipelines, reversing the existing pipeline infrastructure. But Mountain Valley is 95% done and still tied up in litigation. It's going to have to Haynesville, the Gulf Coast, and the Permian, Haynesville in Louisiana, and then the Permian in Texas are going to be the 2 big growth areas. The Northeast can grow, but you got to be able to move it to markets.
You have physical assets on the ground. You don't have the ability to bring it to market. Yeah.
Right, and that's the big thing there.
Well, that's a big challenge for the 2023 strip as well.
Yeah. Yes, exactly. All right, looking to storage here. The STIO estimated October storage at 3.3 TCF. They came down about 40 BCF from their May forecast. We looked here, and if we look here, we'll see also if we grow production to 98 BCF a day by the end of 2022, and we factored in the news from Freeport there, the 220 BCF of supply there is coming back to the market, as well as looking at a warm June, Dave predicted. EA is at 3.39 TCF there. If you factor in some of the other changes, we got 3.2 TCF. Again, that's assuming production's at about 95.5 a day starting June 1st. Where storage is currently at 2 TCF, fewer exports. So pre-Freeport, we were at 3.1 TCF. We're at 3.2 right now. As Brian said, the weather is the king card. That's going to be the big variable here in the next 60 days. If Freeport returns, any other LNG facilities have delays, hurricane storms in the Gulf, that shut in exports, that could be a factor. But again, if we also have the hot summer that Dave thinks is possible now, that could put us closer to 3 TCF, and that would be bullish for next winter. So we have to watch it as we go through here. But the chances of heading above 3.5 where we were last year, probably not as high right now, unless we take a real turn.
We would have to see weather under deliver, and according to Dave and even Brian, that's not going to happen. And the impact, or it just simply, for folks to reinforce that this is a data point that comes out every Thursday, and it's worth watching because as that fluctuates, and right now we're floating below a year ago, floating below the 5-year average. If that starts to trend higher, perhaps even crossing either of those two numbers, that becomes very bearish for pricing. But that is not the outlook either out of the STIO or out of out of our modeling. So Keith, thank you.
Yeah. So looking at power markets, how they responded. ERCOT, see here, set a new all-time record on a Sunday of 74.9 gigawatts by about 200 megawatts. It cooled off. Load was supposed to set a new record on Monday. They came shy by a few hundred megawatts. So again, but we're only in mid-June. As David said, it looks like the heat could reload out there. The wind has been strong, so the pricing action's been mute. You have strong solar builds picking up now that the federal government's waiving. Biden administration is going to waive the solar tariffs for 2 years. Some projects were backlogged there, new solar builds. But we're seeing a grid where you have basically 72 gigawatts to 74 gigawatts of dispatchable generation. You need the wind to show up, and it's going to get interesting in late July and early August probably. That's traditionally where you see wind die. Where we had 25 gigawatts of wind, 20 to 25 gigawatts of wind, you may not see that. MISO came out, NERC, North American Electricity Reliability Council, showed that MISO, if you have anticipated resources of 143 gigawatts, but you have 7 gigawatts of maintenance outages, typically during the summer, and then another 14 of forced outages. Again, as it gets hot and things run full, all out, steady, 7 days a week, breakdowns occur. And then extreme derates, if we have the heat, we could see that MISO could be short capacity, and especially in the Michigan area, Illinois area, northern Michigan. You just had the Palisades nuke retire in Michigan, so you lost that baseload nuclear capacity. MISO is an area of concern. Several years ago, they had a lot more coal capacity. That is being diminished. And then if we look at California, we're looking at, of course, Davis talked about the drought. We're looking at a drought case here of hydro generation where it's typically in a good year 10 to 15% of the supply mix. In California, it's looking like 6 to 7 right now. 6 million, and a million megawatt hours, 6.5 million megawatt hours versus like 13. So half of what it normally is. That's a concern. That's going to have to be replaced by gas-fired generation. And there was a lot of gas in storage in SoCal, so they need to burn some. But this is going to, again, boost gas burns over the course of the summer here. And in New York, New York ISO came out for the summer and said they're good for this year. They have a PICA rule to comply with nitrogen oxide emissions, the NOx rule, that goes into effect beginning next year and then fully 2025, while taking out 1,500 megawatts of simple cycle capacity peakers could cause as much as a 700 megawatt shortfall in New York City Zone J by 2025. So if there aren't batteries or other types of mechanisms, you could see issues in New York City and the East. So what is starting here, as we look here at the last map here, this is NERC's map. You can see the West, all the West with the drought and retirement of coal out West. Tight reserve margins in California, the hydro is a concern. MISO, even more of a concern. If they have if the heat comes in, we're starting to see, you have derates and forced outages. That's and low wind. That's a threesome combination that can definitely play into things. We see, but the East is not immune from some of these issues going forward as well.
So Keith, one of the things that I've had asked of me, and perhaps you guys have as well, is what should customers be thinking about right now as they look at this map? And again, this comes out of the NERC summer assessment. This is their view of perhaps issues where there's going to be perhaps areas where there's going to be reliability issues. Some of the advice or guidance I've given has been make sure that you are tuned into your utilities, your ISOs. Every one of them has got some type of e-alert service that you should be linked into. Clearly, we offer some type of guidance as well as to when we're going to have peak days, so you can sign up for the Constellation service. Right. Any of those will keep you informed, on a day ahead, 2 day ahead basis as to what the outlook is and perhaps where there's going to be issues.
If your energy is price times quantity, what can you do to reduce your usage if we get into a tight high demand situation for 24, 48 hours, especially late in the day. A lot of this is all going to occur from 4 p.m. to like 7 p.m. is when you're going to see the most volatility in the real-time markets.
All right, thank you. Let's take a look at some summer strips and then play cards.
Yeah, well, talking about, West, and this is so COB yesterday with the pullback in NYMEX, you can see people were asking us, oh, is power going to pull back as much as gas? And no, it's not linear, because there's other non-energy cost price that goes into the price of power. But we saw SoCal did pull back, and there's a pullback there because the SoCal storage is full, but they're going to need to burn gas this summer out there. And I would note, you see 2022, most markets, 2022 is trading over 2023. And that across the backwardation, if there's events this summer, volatility, it gets priced into next summer. Markets anticipate forward, next summer 2023. So there's a lot of more up. There's a lot of upside risk. There's some downside gain if gas continues, if production exceeds expectations. Could see a little bit of pullback in 2023. But right now, the volatility, the market is looking at risk this summer with where gas is and tight reserve margins, especially out west. You saw ERCOT pull back a little bit, but we are still going, in the drought and tight reserves there. New York, again, next summer has its risk with the capacity, with the peaker units being retired. West Hub pulling back. Again, you have coal that's helping, but it's not what it used to be because coal is expensive. And ISO New England next year could be higher if there's continued problems.
So Keith, with the pullback that we saw yesterday, and granted some of that pullback has come back into the market today, thoughts on why power prices have not necessarily responded in kind?
I mean, you have RPS requirements, like in the east, states joining RGGI. You have transmission upgrades. There's non-energy components that go into the overall power bill that aren't going to follow NYMEX on
tighter reserve margins.
Tighter reserve margins, yes. And older gas units now being required to run that are at higher heat rates, not as efficient, and that's going to be priced into the market as well. So
okay, so I'll take us one step back. You had mentioned Palisades and the retirement of that nuke. There's one nuclear plant under construction in the States right now in Georgia. Do you see any more new ones on the horizon?
Maybe the smaller module ones, but right now, no. I mean, the one in Georgia, it's what, $15 billion cost?
Debacle.
It's not, and out west, will they retire Diablo Canyon?
True. California has started, their tide has started to turn perhaps on whether or not Diablo Canyon will remain online for at least another few years. All right, Brian, let's consolidate some thoughts for folks on how to think about present market conditions, how they as a buyer might want to think about what could happen to swing prices further, either up or down. And tell us if you won your local poker tournament this weekend.
Well, we got together and talked a little bit ahead of time before the webinar and said, what does the market feel like? It feels a little bit like a high stakes poker game. And so in that regard, we came up with a high stakes poker game. And so you have a couple of cards in your hand, regardless of who you are and what your position is. When we came, well, you're alive. You're you've got. I can't see the further animation on the.
Sure. You want?
Yeah, bring up my buyer's hand. Okay, so you've got a couple of cards. And your cards are, regardless of your position, that rig counts are, getting back up to pre-COVID levels, and we're approaching that kind of territory. We have a ways to go yet, and you just got dealt a pretty good card if you're short, and that card is the Freeport terminal halts exports for 90 plus days. So you've got a jack and a 10, and the market has a lot of good cards that you could get in addition to that to build on that position. Or if you're short and you're holding, you could get 3 really bad cards and blow yourself up at the same time. And it works the other way as well. So we created sort of like a poker deck, 5-card stud kind of deck, and gave each of the cards a face value. And then, so for instance, if you have the Freeport terminal shuts down for 90 days and production it's a 95 a day. I mean, it's above year over year levels. So it's not as if production has fallen year over year. It just has been flat year to date. Very important distinction, more or less. So if you see the best possible hand that you can get from here is that you get some Gulf storms. Dave's talked about a very active season potentially coming up. Dave, you were talking about it being more of an East Coast event though than a Gulf Coast event, if I recall. Is that true?
Yeah, I think the risks are more toward the Southeast and the East Coast in general. But if we did happen to get something in the Western Gulf, that could certainly affect the repairs going on at the LNG terminal.
Well, I'm also talking about affecting the shipping itself. So like you disrupt cargoes, deliveries, and back those cargoes back up into the United States for a while. So an active and consistent season in the Gulf Coast could do that, and that's what that card represents. So if you see a severe and material change in the weather, so right now we are hot as blazes, and we are forecasting hot as blazes. If something happens over the next 6-7 weeks that says, you know what, there's going to be a material shift in this summer forecast, and we're going cooler on a population weighted density average where generation counts, that would be a king card that would go on top of your tin and your jack. And then if production gets above that dotted line, like really consistently and above the dotted line, not just on it, but above it, and signals that it's going to 100 by the end of the year, pretty
strongly,
very strongly and very consistently, and it gets a lot of confirmation of that. That's an ace. That could, to me, again, the market's looking for the signal. The signal is the ace card. The ace card is production. Does it get going? You get a break in the summer weather. It goes cooler. Doesn't have to be cold or anything, right? Doesn't have to be below normal, but it has to be materially cooler than the hottest summer of all time. It can't come in the third hottest summer of all time. Like, oh, it's all clear. We got a great break on the weather. But it would have to be like, okay, we're really changing. And then, of course, Gulf storms keep back up some material cargo, number of BCFs into the market. That would be your really great hand that you could get where you are today with a jack and a 10.
And the interesting thing is, the options market tells you that there's probably a lower probability of getting that to happen than to get those cards in a row if you were playing poker.
Right. Ed did a little math for us there.
And the odds in the background.
Odds, yeah. Now, let's go to the other extreme, which is Fold'em. So, rig counts again. You've got production year over year is higher. You've got production year to date is flat. Freeport gave you a jack, but then production lags or flattens or goes down. What if it goes down and ticks down for the rest of the year? That's a possibility. That could happen. Super hot. What if it's even hotter than Dave's saying? My gosh, that would be and then you have an active hurricane season with some production outages, actual gas production outages on top of that. That would be a Fold'em kind of hand because that would really drive prices to the upside. And then you have some wait for the turn and the river cards for those of you familiar with Texas Hold'em style poker. And if there's a shift in the administration, that is a regulatory shift. Hey, we want to give the green light to MVP. We want to get pennies back online. We want to talk about not just keeping or bumping compression on Permian Highway, but building another lateral on it. Or, we're really going to change that. And then I think China lockdowns are a big part of the global demand for oil and also for LNG coming in this winter. So there's a number of different what I'll call wild cards out there. That recession, of course, is a huge one.
And Brian, the U.S. and even more Europe and Asia too, these higher energy prices.
Yes, recession, global recession, and I'm going to throw out there that stagflation. Maybe we can talk about that next time. But stagflation is, I think, a huge risk of where we could be in a situation where energy prices keep rising, but unemployment starts to rise and interest rates are rising as well. So. But I think that if you look at the market, where you are matters in terms of your chips on the table or your position right now. If you're long or short, and what's your weighted average cost of future, if you've bought some for the future, how much do you have? What's the weighted average cost of that? Those are the chips that you have on the table as well. And these are the cards that you could be dealt in the next couple of months. So again, speaking to the upside price risk versus the downside opportunity, the upside price risk still outweighs the downside opportunity by a factor of 3 or 4.
And then that would translate to customers considering perhaps keeping risk off again, and then buying a little bit more because that risk to the upside could still be considerable. So as I think about positioning, again, for the summertime, your runway is getting short here. But clear as you should look out to the fall and into the wintertime periods, again, buying little bits as the opportunity presents itself like it did yesterday, still probably the best course of action.
Agreed.
Okay.
Yeah, right.
All right. So we do have some questions, and I'll say that I'll page through them here, but the couple things that struck my mind, we didn't talk about this yesterday as potentially a price driver. Ed, you and I have chatted about this as I know we all discussed this, and we thought this was potentially yesterday when we saw the big downslide in natural gas pricing. Tell us a little bit about how margin calls can factor into that and how that can accelerate pricing and perhaps even drive it further if margin clerks now start looking at prices present day. And
most of that's done automatically, so clerks are gone.
And deciding whether or not the risk has to come off.
So when you trade on leverage, which is spending more money than you have cash up front, you have going margin, and equities are 2-to-1 margin, so you can buy twice as much stock as the money you have in your account. Commodities are a different story. You can be highly leveraged, generally at 10-to-1. So when you get a big move against you, you need to put up a good faith bond to indicate your performance. And when prices go against you, generally people pull out. And when prices go against you substantially, you need to find other sources of cash because you're out of luck. You owe more money than you actually have. So you're looking at other assets to sell. So it starts an avalanche in price down. So if you're sitting there with a natural gas position that you need to kind of put up a substantial margin for, you'll go sell something that's actually a really good asset, say a equity on Exxon, I'll just pick up stock, or Microsoft or something like that. You'll just sell that stock because you need ready cash. And all of a sudden, you're kind of just pushing the momentum downhill. And the really good version of this is cryptos, right? Like people were leveraged up pretty highly to be in this crypto game, and now they're going to have to sell some real assets to just meet their calls. They call them margin calls. When you get a call from the margin clerk, just to stay in balance. And you're seeing a lot of evidence of that over the last couple of weeks.
All right, thank you. Brian, speaking a little bit about LNG exports again, and this ties back to your comment a moment ago, your question with Dave around hurricane activity in the Gulf. So hurricane activity obviously can slow down the transport of the ships. You can pause the ships coming in and out of the various terminals along the Gulf. What's the risk there as well to energy production?
Well, it's a lot less than it used to be. So if you look at energy production in 2005, Katrina Rita, which was the last big major disruption, about 40% of all natural gas was produced offshore in the Gulf Coast of the United States, and now about 2
BCF, about 2%.
Yeah, okay, 2%.
Yeah.
It's almost nothing. So there's some potential to disrupt, but not much.
And it's also by the rumor, still the news, right? Hurricane coming, you'll buy things up, and then the reality comes, and it's not a big deal.
It's the processing plants. If you get power outages to take out the gas processing plants for the onshore production, then you have now suddenly half of Texas production is shut in, Louisiana production is shut in. Now you have a bigger.
And there's
issue.
usually Cat 4, Cat 5 types.
Storms. Yeah, they have to hit that Texas, Louisiana sweet spot.
Correct. And then even the lower level storms just simply cause people to stay home. The production gets shut in. Yep. They've got to clear out the flooding. Even if nothing breaks, that process
just a couple
takes
of
a few
days.
days. Yeah. Correct. So those types of events can be very bearish. Another thought here, just perhaps Keith, one of the things that we had talked about, LNG and the exports. What potentially would it take for a complete halt of exports, right? So not necessarily something weather related. This is perhaps more of a policy question, but terminals highly supportive of LNG shipments to Europe at the moment. Asia is very dependent upon those. Question comes in, well, what if we stopped all that, or how would we stop all that?
It would take an act of Congress or
Yeah.
I mean, you have long-term contracts that would be
We have
broken.
contracts. You'd break business contracts and just kind of shatter the whole premise of American business. And
It would be not
that'd be a big deal.
Yeah, it would upset the trade imbalance as well.
Yeah.
Mhm.
Yeah, so I don't think that's happening. Let's talk a little bit about a recession and reduction in energy demand. So Ed, realize you probably don't have hard numbers for this, but any sense of what a recession could do to energy consumption? And maybe this is a question we explore in a little bit more depth next month.
And you look at natural gas, and it actually could probably not change. You can see a recession come, people get unemployed, but at the end of the day, it's still the cheapest BTU on the planet. We talked about that global arbitrage before. And as long as, natural gas here is $9 and gas around the world is 20 plus and crude is 20 plus on a BTU basis, processes are coming here to arbitrage that out. And until that changes, you're not going to see a big drop in industrial demand.
And you'll see that reflected in like ERCOT power load. ERCOT continues to grow as an ISO, setting all-time record loads on a Sunday, in June, not just the month of June, but
which is crazy, right?
Yeah.
On a Sunday.
Never happened on
Technically
Sunday.
not even in summer yet.
Right.
Yeah.
So a long few months ahead. All right, folks, we have plenty of questions here. We will get back to you directly. I want to hand this over to the Tomato King, who's sort of in a tomato color today. And tell us a little bit about his garden.
Well, first of all, did we get other pictures to come in here? Or?
We did.
We did?
And we encourage that. So,
Okay.
Anybody listening who's growing tomatoes at home, we would be happy to,
So I want to ask,
to share your progress.
Whoever is left on the line who wants to and who wants to come into the Tomato Club, you got to send some pictures to us at CMG Constellation, and we will put them up. We really would like to get some more people on the in the club here, because there's like just me now. But
Hey, I participated.
Greg did participate.
And we have Mike.
We got Mike Farbach. Okay.
On the Bourbon Trail series.
You might recall that Mike challenged the Tomato King last year to a tomato
Well,
Look at
battle.
his beds. He's coming back with beds and everything.
Look at that.
Fencing and everything, Brian.
That's probably electric fencing.
Yes.
Like the crosstown rival.
We will see how the harvest goes.
I'm not doxing Mike, but I know where he lives. Okay, and
That's fencing probably to keep you out.
that's what I was saying.
Right.
It could be a late night sabotage here. Mike, looking good there, my friend. Look very nice.
Arpita and now Arpita's dealing, she's in Houston and she's dealing with some heat down there.
Aha, we have yes, very nice, but we still see a little bit of ripening fruit, but dealing with. Let me suggest you're probably watering too much. Actually, you got to be careful about that and get some heavy mulch on the bottom.
Funny that that would be the issue in California.
Yeah,
Too much water.
Greg, I don't know.
I'm looking forward to that one cellar.
Yeah, we might have to go to the ER, the tomato ER with these. Tomato doctor. Is there a doctor in the house?
Make a house call.
I haven't overwatered my tomato.
Keith, look at Keith here. He's went, and I can see that organic compost that he's using on the bottom. Didn't you, Keith?
Yes.
You followed my advice there on no dig.
So, Brian, at this point in the season, if you have not got your plants in the ground, is it too late?
Where are you? If you're in California?
I'm just saying hypothetically for our listeners, if you have not yet gotten your plants in the ground, too late. Or
it depends on what grow zone you're in. If you're in Florida, you can get plants in the ground right now, no problem. If you're in southern Georgia, if you're in Michigan, it's too late. So it depends on where you are.
A lot of our listeners come in out of the southeast, Houston.
Definitely you can plant some plants now,
right.
and you have the time.
Okay, so time is not too late.
Time is not too late.
David's saying go for it.
Right. Yeah, and the weather is supportive. All right, so we're going to call it there, folks. Until next time, July 20th, 2 p.m. Get your tickets now. There is a Fortunato and Friends broadcast coming right up after the July 4th weekend. I will acknowledge that we did not post, after my admonishment, we did not post a link to the PDF deck. GoToWebinar was for some reason restricting that, so that was technical difficulty. We will get that resolved for next time, and we will email you all a copy of the deck free of charge. And again, if we were not able to address your questions during today's call, we will have a record of it. We'll respond to those directly, post most popular Q&A to the blog. If you think of a question later, feel free to send it to that email address you see there at the bottom of the screen. And we look forward to seeing you on July 20th. Enjoy the first month of your summer, and Thanks again for taking time out of your day to join us. Have a great day.
Join us for Fortran Friends on Thursday the 7th. We have Laura Gambles, president of PNC Bank. She should be really good on.
We're going to talk about what's hot and what's not in the economy.
Yep.
Yeah.
All right.
All right, folks. Thank you.